Hey everyone, and welcome. Today, we are cracking a code that's been hiding in plain sight. It's a simple little key right inside a mutual fund's name that can instantly tell you its risk level. Seriously, let's jump right in. So, if you've ever thought about investing in Israel, you know the feeling. You're faced with this giant wall of options, literally 3 to 4,000 different mutual funds. It's just overwhelming, right? Where do you even start? Well, what if I told you the most important clue wasn't buried deep inside some 100-page document? What if it was right there on the surface, just sitting in the fund's name the whole time? That's right. Every single mutual fund in Israel has a simple, standardized code baked right into its name. And it's there for a reason, to give you a quick, at-a-glance snapshot of its risk and its basic strategy. So let's break it down. Okay, so this code is actually super simple. It's just two parts. First, you've got a number, and that tells you all about its stock exposure. Then you've got a letter, which clues you in on its foreign currency exposure. For instance, if you see a name like Pasago Winning Stocks 3C, that 3C isn't random, that is the code.
So we know there's a number and a letter, but what do they actually mean? It's time to get our decoder rings out and really crack this thing open, piece by piece.
Okay, first up is the number. As you can see here, it lines up with the maximum percentage of the fund that can be invested in stocks. It starts at a nice safe 0 for funds with no stocks at all, like a pure bond fund, and it climbs all the way up to 5. The rule of thumb is easy. Higher number, higher potential risk, and of course, higher potential reward from stocks. Next, we've got the letter. This works exactly the same way, but it's all about the fund's maximum exposure to foreign currencies, like the US dollar or the euro. A means it's keeping things pretty local, with up to just 10% exposure. But an E? Well, that means it could be exposed up to 200%. This is a really critical piece of the whole risk puzzle. All right, so theory is one thing, but let's get our hands dirty. Let's take this newfound knowledge and apply it to an actual fund you might see out there. Okay, let's decode a fund called Azmut 2A. First, we look at the number. It's a 2. We check our little chart, and bam, that means it can invest up to 30% in stocks. Next, the letter. It's an A. Okay, that means up to 10% in foreign currency. So what does that tell us? Well, it tells us this fund has a pretty low to medium risk profile. The majority of its money, at least 70%, is going to be in other things, probably bonds. See? Simple as that. Now, I bet some of you were thinking, okay, the stock part makes total sense, but why a whole separate code just for foreign currency? Why is that risk so special? And you know what? That is a fantastic question. The answer, in one word, is volatility. I mean, these days, currencies like the dollar and the euro can jump around like crazy, almost like they're stocks themselves. This creates a kind of double whammy for your investment. Your return isn't just about whether that European company you invested in did well. It's also about what the euro did against the shekel. If the euro takes a dive, it can chew away at your profits, even if the stock went up. Knowing that exposure helps you decide if you're comfortable with that extra layer of risk. But wait, there's more. The code actually has a few more little secrets tucked away. Let's see what else this fund's name can tell us. Okay, let's go back to those tables for a second. You probably saw some numbers that looked, well, kind of impossible, like 120% or even 200% exposure. How on earth can a fund invest more money than it actually has? The answer is a really powerful and risky financial concept called leverage. Leverage is basically when a fund uses financial tools like loans or options to seriously amplify its investment power. This is the definition of high risk, high reward. It can pump up your potential gains like crazy, but it does the exact same thing to your potential losses. So when you see a 4 or a 5 in the name, you know you're looking at a fund that's playing in the big leagues of risk. All right, we are on the home stretch. There's one final piece to our puzzle. Every now and then, you'll see a Hebrew letter at the very end of the fund's name, either a peh or a ket. This little character tells you something incredibly important about taxes. So a fund with a peh is called an exempt fund. This means the fund itself doesn't pay capital gains tax. Instead, you, the investor, are on the hook for the tax when you decide to sell. A fund with the high is a liable fund. In that case, the fund pays the tax on its gains, and you don't have to worry about it. It's really just about who gets the tax bill. So why choose one over the other? Well, here's a little inside baseball for you. The vast majority of funds in Israel are exempt. And honestly, It's mostly for marketing. By not paying the tax at the fund level, they get to report higher pre-tax returns, which, makes their performance look a little bit better. What this means for you is that in most cases, you should just assume you'll be the one dealing with taxes on any profits.
And just like that, you've cracked the code. What once looked like a totally random mix of names and numbers now gives you this incredible advantage. I mean, think of it as your new investing superpower.
So let's do a quick recap with your new decoder ring. The number, that's your instant read on max stock risk. The first letter, that's the max currency risk. And that little letter at the end, if it's there, that tells you who's paying the tax man. And of course, the name itself, like Pasago or Metav, tells you who's managing the money. You basically have an X-ray of the fund's entire game plan.
It all comes down to this one simple but really powerful idea. By just reading the name, you can understand the fundamental risk level of any mutual fund in Israel. No more guesswork, no more feeling completely lost in a sea of options. This knowledge really puts the power back in your hands. It lets you instantly filter through thousands of choices and start to zero in on what might actually make sense for your goals. So the final question isn't about what the code means, it's about what you're going to do with it. Now that you can read the code, which level of risk is right for you?